Welcome to this video where we will focus on a few things to consider when acquiring those big ticket items, or what we call capital investments. Farms and ranches are very capital intensive businesses and require a lot of things that cost a lot of money, such as land, buildings, equipment, and even breeding livestock to function. The question for individual managers is, how do we obtain the use of such capital assets in the most economically rational manner? Today we're going to talk about what is meant by the term capital investment. Then we're going to introduce you to three very important economic concepts or considerations that should enter into the evaluation of each major purchase decision. Specifically, we will introduce the concept of feasibility and why it is important. Then we'll introduce the concept of time value of money, which will lead to a discussion regarding how we evaluate the profitability of major purchase decisions. Two characteristics make something a capital investment. First, it is something that is not used up in just one production cycle, but rather can be utilized for a longer period of time. So inputs like fertilizer or feed would not be considered a capital investment because we use them up as we buy them and use them each production season. Basically, we think of items that last more than 1 year. And again, most of the time, we're talking about things that cost a significant amount of money. The second characteristic that must be present in order for something to be considered a capital investment is that it does, or would if we are considering buying something, have some economic implications for the business. It would help with production, for example, which would in turn generate income, or it is something that will save the business money relative to what the business is currently doing. Examples include such things as land, which would be used to produce something for the business, or buildings, which would house something on the farm, either reducing the weathering impacts or allowing us to store something that otherwise we would have to pay somebody else to store for us. Another good example is breeding livestock, such as a young beef cow that we intend to keep for several years and raise calves from. There are, of course, things that we all spend significant amounts of money on that we intend to keep and use for several years that do not have anything to do with our business. Items such as a family car or even a nice television set for the house are big ticket items that we purchase, but they would not be considered capital investments but rather just personal living expenditures. So again, capital investments are those big ticket, long-lasting items that we intend to use for our business. There are several specific categories that we use to, again, categorize capital investments. The first is simply replacing an existing machine or other long-lasting asset with a newer version or less worn-out version of the same asset. Replacing a 60 horsepower utility tractor that is worn out with a lower hour tractor of the same capacity and with the same capabilities would be a good example. The second category is cost-reducing capital investments, or replacing an existing capital asset with something that will do the job but at a lower cost. A good example of this is a friend of mine who runs a trucking company. He discovered a long time ago that certain truck models that he could purchase for his business got the job done with significantly less fuel than some of the trucks that he had at the time. So at that time his fuel bill was running about $30,000 per month. So following a plan to replace existing high operation cost trucks with ones that operate on much less fuel really helped out his bottom line. We can all think of examples in agriculture where certain technologies allow us to get the job done at a lower cost, and we all have to weigh the benefits of that cost reduction against the annualized cost of obtaining the newer technology. Individual row shutoff triggered by GPS on a planter is a good example. That technology for similar sized planters costs about the same regardless of how much you use the planter, the shape of your fields, or the type of seeds that you typically plant. But obviously that technology has more value to someone planting a lot of high-priced seed, corn for example, relative to grain sorghum, on a lot of acres involving irregularly shaped fields. The third category or general type of capital investment is what we call revenue increasing or capacity increasing investments. Simply put, buying bigger equipment or additional equipment to replace or enhance smaller equipment. These types of capital investments are considered all the time as the farm or business is expanding and outgrowing the capacity of the existing equipment line. It's that old question, should we hire more help and run the existing equipment more hours, or should we obtain larger equipment? Another potential category of capital investment is to invest in something that is unrelated to the current enterprise mix or scope of the business. This could be about anything. For example, a farm family deciding to purchase and operate a restaurant in the local community, or even a farming operation that is currently involved only in crops, deciding to diversify and invest in a cow herd. Finally, we can think of capital investments that fall into more than one of the preceding categories. For example, a farmer may decide to replace his or her current combine with a much larger one, with the intent of starting a custom harvesting business on the side as well. So the new purchase would be a replacement, a revenue increasing investment possibly if they were thinking of taking on some additional land to farm, and an outside the current business investment, and may even be a cost reducing investment consideration if it harvests more efficiently than the older machine. The term we use for the process of evaluating capital investments is capital budgeting. The steps to evaluating capital investments from an economic perspective include 1. Identifying the alternatives that we're going to consider, 2. Estimating streams of cash receipts and cash costs over the expected life of the asset for each of the alternatives that we're thinking about. Step 3, evaluating feasibility and profitability of each of the alternatives we're considering. And 4, selecting the best investment alternative. The first step may actually be the most difficult because we all know there are an unlimited number of things that one can spend money on. However, we can narrow down the list of possibilities by referring back to our business vision, objectives, and goals, and considering only those things that move us in the direction we want to go in the long run. Sometimes it's fairly straightforward. We added some land to our operation and we need a larger piece of equipment, for example. Even then, there are probably multiple choices with regard to brand, features. Do we buy new, or do we find a good used item to get the job done? Step 2 involves obtaining information regarding original cost, expected life, salvage value for the various alternatives that we are considering. In addition, we need to estimate how much money the investment will generate, either producing or saving us money for each year of its expected life. For example, purchasing a combine to harvest our crops ourselves rather than hiring the job done obviously saves us the custom harvest bill every year, but we do have to provide labor, fuel, repairs, and other cost items associated with owning and operating the combine. So we include the operating cash revenues or savings net of the operating costs. However, in capital budgeting analysis, we don't consider the interest or principal payments on the annual cash operating projections, as those items are taken into consideration in the various evaluation tools that we're going to use. The next few slides provide information regarding how to appropriately evaluate capital investment alternatives. The first point that we need to be sure that we fully understand is that feasibility and profitability are two very different but equally important economic considerations. In order for a proposed capital investment to be a wise decision to move forward with, it needs to satisfy both criteria. Feasibility simply answers the question, can we pay for it? Many investments can be profitable in the long run, but are simply not feasible in the meantime, for our individual situation anyway. Historically, land has been a common example of this. It may be very profitable in the long run, largely because of increases in value over time, but it's darn hard to pay for in the meantime. For things like machinery, buildings, breeding livestock, or even land, the key is to compare the net operating cash flows, net of taxes and some other considerations, with the scheduled principal and interest payments. In many cases, the investment will not generate enough cash to make those payments. That doesn't necessarily mean it's a bad idea. It just means that we need to recognize that additional cash may need to come from somewhere else besides that particular income-generating investment to help make those payments. Whether that is possible and to what extent depends, of course, on individual circumstances. Arguably, the most common feasibility-related capital budgeting tool is the payback period calculation. The calculation reveals the number of years of after-tax net cash flow needed to pay for the initial investment, and it is calculated as the initial investment divided by the average net operating cash flow. For example, a piece of equipment that costs $10,000 and is expected to generate an additional $2,000 per year net after paying all operating expenses would have a calculated payback period of 5 years. Since these are projections, one should always do this calculation not only based on average expectations, but also based on alternative projected scenarios such as best case or worst case. In other words, how certain are we that that projected $2,000 of net operating cash flow will actually materialize? You compare the calculated payback period with some target required level that you have in mind. Perhaps that required payback period is related to how long of a loan you can obtain to purchase that particular type of asset. If the calculated payback period is less than your required target, then it's much more likely that the net earnings will come close to making the payments, for example, which make that project more attractive from a feasibility perspective. Finally, if we're comparing two different alternatives that will both get the job done equally well, we generally consider a shorter calculated payback period to be preferred relative to a longer payback period. Before we can talk about tools to evaluate the profitability potential of capital investment alternatives, we need to be reminded of the economic fact that money loses value over time. In other words, we can't spend $1 today to get $1 back at some time in the future. We will lose money every time on that proposition, because that dollar in the future has less value to us, purchasing power, etc., than $1 today. This time value of money concept is reflected in an interest rate often called a discount rate that we observe at any point in time. The higher that interest rate, the faster money loses value over time. This simple illustration shows that at a 6% interest rate, $100 received about 15 years from now would be worth nearly $50 today, while at a 9% interest rate, that same $100 received about 15 years from now would be worth only about $30 today. At either interest rate, $100 received a long time in the future, say for example 30 years or more, is not worth very much today. We use this time value of money concept all the time. For example, we rely on time value of money in a positive way. We call that compounding when we're saving for retirement or investing. The longer we have until retirement, or the higher the returns that we expect we will be able to consistently earn on our retirement portfolio, the larger the nest egg we will have when we get to that point in life. We use time value of money in the opposite direction. We call that discounting when we are evaluating the merits of purchasing something that will generate operating cash flows well out into the future, buying these big ticket items that we're talking about here today. The whole idea is to figure out what those future cash flows are worth to us in today's dollars, which tells us whether it's profitable to purchase a capital investment for the price that is being asked, or is it worth it? Not to make this too complicated, but when compounding, we multiply dollars today times the quantity of 1 plus the interest rate to the nth power, with n being the number of time periods. For example, $1 invested for 3 years at 8% annual compounding would be worth about $1.26 in 3 years if we were to save that for the future. What's the point here? If we're using money that we have on hand to buy things, there's an opportunity cost associated with doing that, because that money could be earning us money in some alternative investment if we were to use it for such. When discounting, we do the opposite. We divide that cash flow that we will receive at some time in the future by the quantity 1 plus the interest, or in this case discount rate, to the nth power. In this case, $1 received 3 years from now is only really worth about 79 cents in today's dollars, assuming an 8% discount rate. What's the point here? Future incomes may not be worth as much as they initially appear to be worth. So again, the way we calculate today's value, the present value of some net income or net cash flow that we expect to receive at some point in the future, is to divide that net cash flow by the quantity of 1 plus the discount rate to the nth power, with I in this case being the relevant interest rate in decimal form and n being the number of time periods into the future that we are looking. In capital budgeting, we're usually thinking in terms of years. So for example, $20 received today is worth $20 today, no discounting necessary. But $30 expected to be received 1 year from now is only worth $27.78 today based on an 8% discount rate, or 30 divided by the quantity 1.08 to the first power. By the same token, $40 expected to be received 2 years from now is only worth $34.29 today. $40 divided by the quantity 1.08 to the second power. So if that were the net cash flow stream that a particular investment alternative we were considering purchasing was expected to generate, the value of that cash flow stream in today's dollars is simply the sum of the discounted cash flows, or 20 plus 27.78 plus 34.29, or $82.07. To get to the commonly used capital budgeting profitability measure known as net present value, we take that discounted value of all the future cash flows and we subtract off what the investment would cost us if we were to purchase it today, the initial purchase price, and see if that result is negative or positive. In this example case, it is negative, which indicates that this capital investment alternative would not pass the profitability test. When using the net present value evaluation tool, NPV as it is commonly known, if we are only considering one investment idea, we are either going to do this, purchase this piece of equipment, or we're not going to do anything, we simply look for a positive NPV, which indicates the idea is profitable if all of our underlying assumptions turn out to be true. That, of course, is why it is critical to do some sensitivity analysis. As mentioned before, that involves plugging some alternative numbers into the calculation to see if the investment still looks profitable if some of the future cash flows don't turn out to be quite as good as we projected. If you are comparing more than one alternative, say I may buy this tractor or I may buy a different brand of tractor, we usually say that the one with the highest positive calculated NPV is the better choice, or the most profitable. Caveats to that statement include when we are trying to compare NPVs across alternatives that have significantly different expected lives or different degrees of perceived risks. Methods are available to compensate for those issues, but that gets a little beyond the scope of this video. Oh, just in case you're thinking, wow, this looks like a lot of complication and a lot of calculations, who's going to go to that trouble? Rest a little bit at ease, because there are plenty of calculators and pre-programmed tools available to do the number crunching for you. What is important here is that you understand the concept. Another profitability evaluation tool that is closely related to NPV is internal rate of return, or IRR as it is commonly called. Without getting too bogged down in the details, when doing the NPV calculation on any set of facts or set of net cash flows, the higher the discount rate used, the lower the calculated NPV will end up being. In other words, a higher discount rate makes it harder for any proposed capital investment to pass the profitability test or have a positive NPV. For any set of facts or any proposed investment, the discount rate that causes that NPV calculation to switch from positive to negative, or in other words, the point where it is right at zero, is called the internal rate of return. So a higher internal rate of return in general means the proposed capital investment is projected to be more profitable. Think of it as a projected return on investment in percentage terms. So if the projected return on investment, or IRR, is higher than the cost of capital used to buy the investment, for example, the interest rate on borrowed funds might be a good place to start, then the project would be considered a profitable investment. So if you are only considering one alternative capital investment and the calculated internal rate of return is higher than your cost of funds, the interest rate that you can borrow money for, the investment would be considered profitable for you. Of course, as with the other capital budgeting tools, the result depends on the accuracy of the facts that you put into the analysis, or more specifically, on the accuracy of your net cash flow projections in future years. So again, it is very important to at least consider scenarios where the cash flows are not quite as rosy as the average projections that you use in your initial evaluation. When looking at more than one potential alternative capital investment using the internal rate of return method, the largest internal rate of return is considered to be the best choice in most instances, meaning choose the one that is projected to generate the highest percentage returns. Most of the tools that I mentioned earlier that are available to do NPV analysis will also do internal rate of return analysis. So once you have thought about the cash flow streams, the evaluation can be done for you. To wrap up this video segment, always keep in mind that feasibility and profitability are two very different but equally important considerations when looking at purchasing those big-ticket, long-lasting assets for your farm or ranch business. You need to know if you will be able to pay for it, and you need to be assured that it is a wise decision with respect to the potential to make your operation more profitable. We often use the capital budgeting tool called payback period as one tool to evaluate the feasibility of investment decisions, and by the same token, net present value and internal rate of return are the most commonly used capital budgeting tools for evaluating the profitability of major purchases. In the next video, we will evaluate the wisdom of a significant proposed capital purchase based on our case farm example.